The earnings for the second quarter are expected to be very high, up 61% as compared with last year. 10 of the 11 sectors in the S&P 500 are expected to show positive year-on-year advances, with many of them growing by triple digits. So this, believe it or not, will be the second strongest quarter over the last 25 years, second only to the fourth quarter of 2009. Well, we're in a sense attempting to come back to normal, so that when you look at the sharp sell-off or shortfall that we experienced in the second quarter of 2020, and then look at the very sharp advance for the second quarter of 2021, obviously over an extended period, it's really just going to be along the overall upward trajectory that we see for corporate profits. Back in 2009, the reason that we had such a strong advance is that in 2008, we basically lost money in the S&P 500. It was not that it simply was down year on year, but we found that the S&P 500 in that final quarter of 2008 actually lost money for the first time in history. I think investors should definitely be very watchful of what will happen going forward. First off, I think they have to realize that this kind of growth was anticipated by investors. And as a result, you might find that investors begin to sell into this strength, taking profits because their forecasts had come true. Now I think we need to focus on what corporate management will be saying about the third quarter, the fourth quarter of this year, and into 2022. Because the third quarter of this year is expected to show gains of 21% in earnings, and the fourth quarter an advance of almost 18%, so still double digits, but dramatically lower than the second quarter number. And if we look to 2022, expectations are for a near 12% rise in earnings. So we're still coming out of the pandemic, still seeing stronger than historical earnings growth, but it's something that is certainly waning. Well, I think investors should realize that the very strong gains are certainly behind us, that the growth in the speculative areas will likely slow, and we're probably going to see a rotation into the higher quality companies as the economic expansion matures, as earnings increases begin to moderate, and as this bull market ages. So I think investors need to realize that maybe you don't want to be focusing on low quality stocks, but increase their vigilance toward high quality stocks. Well, people certainly have to consume, and usually in a rising economic environment, that the consumer discretionary items do well because people feel confident enough that they can spend their money on things that they want, not that they necessarily need. But certainly when you do have regulatory restrictions, it's like building a wall ever higher and higher. It's harder to get over that. So you could find that individual equities might have their challenges. Interesting, but consumer discretionary is expected to be the second strongest sector in terms of earnings growth, seeing a more than 150% rise in earnings. So consumers are out there spending. They're happy to be out from the lockdown scenario and to be out and about once again. So they're looking to spend some money to make up for lost time.